Hey everybody, I'm John Carvello, president of Stone Oak Capital and Divestopedia. I'm super excited for this discussion today on the state of private equity in Western Canada. Given the number of people that have signed up for the discussion, it's obvious that there is lots of interest in this topic. It's actually super crazy how many people are on our call today, so I'm really excited about it. I was mentioning to the panelists that it's probably because of the quality of the panelists that we have today. We really do have an amazing group of Western Canadian private equity professionals joining us. Mike Cook, co-founder and managing partner at Equicapita. Shiva Dean, vice president, private equity at Hokinson Capital. And Terry Freeman, head of investments at ATB Private Equity. Welcome, gentlemen. Thank you for joining me today.
John?
Before we start, I just want to let our audience know that if they have any specific questions, please get them in and we will address them at the end of the hour. So Shiva, let's start with you. You recently joined Hokinson Capital. Congratulations.
Thank you very much, John. Thanks for having me here today. It's really appreciated. It's been about 7 weeks now, so I'm still very much in a learning phase and a ramp-up phase.
Wow, and they just threw you right into this panel discussion, so I really appreciate it.
Oh, thanks so much.
Yeah, for sure. For our audience, why don't you give us some context and an overview on your firm and investment criteria? So specifically, the size of deals you work on, region, industry, transaction types.
Thanks, John. We're a little bit more quiet than other firms, so I really appreciate the chance to get our message out there. We're a family office, right? And we invest money on behalf of the Hokinson family. We're not on a fundraising circuit. We don't go out to the market looking for other investors or that sort of thing. So it's a bit of a different model than I think a lot of people are used to seeing. Our equity investment size is between 5 and 50 million, with really the sweet spot being between 10 and 30 million. We're patient capital. We don't have a fixed timeline. So a little bit different than other funds that might have to exit in 3, 5, or 7 years type idea. We invest in businesses that we can understand, which I'll just put that out there. So industrial type businesses, we do retail, we do a number of different things, but definitely businesses that we feel we can understand. We avoid science projects. We are not venture capital, so there's no spray and pray mentality that we have in our investing thesis. And we look for businesses that have good defensive positioning and enduring profiles, right? So things that are going to be around, we feel, for a long period of time. Businesses that have a good value creation capitalist behind them. So if you think about businesses with a novel business plan, sectoral tailwind, or another growth driver, those are very important for us when we look through our thesis. And we really want to grow the value of the business over time. So the quality of the team is super critical to us. We look for management succession. We look for businesses that typically have friendly management succession issues. Older shareholders who are looking for an exit, have a good business with good management. Owners who want someone who will look after their company, right? Somebody to come in and really partner up with and kind of grow the business out over time together. So people who co-invest with us in a partnership, and we want to see the management teams realize their full potential as well. So, when we look at it, our brand, if we want to be positioned somewhere in the marketplace, would be a brand that people want to sell their business to because we're known for our ethics, our culture, and how we look after the businesses that we acquire.
Awesome. That's a great overview. And do you guys invest in other asset classes as well, real estate and?
We do.
Okay, awesome. Great. Thanks for that, Shiva. Mike, do you want to give us a context for our audience around, the transaction types that you guys work on and what you're looking for in an investment?
Sure. And before I do, though, I'd like to commend Shiva on a very impressive overview given 7 weeks in the job. I'm actually, given that I've been in my business for 8 years, I'm not sure I can do as good of a job as that. So good job, Shiva. We started Equicapita in 2013 with not actually what it sounds like too dissimilar of a mandate to Hokinson, in that we are looking to acquire super majority up to 100% positions in stable cash flow generating businesses that represent what we believe to be the best of the Canadian economy. And we've, over the course of our life cycle, we have acquired 12 supermajority to 100% positions in companies that fall within 5 key silos that we're looking to continue to build out in our diversified portfolio. And those fall within industrial, royalty and franchise, distribution, healthcare, and then environmental and regulatory. We're typically looking in a similar deal size to what Shiva had said. We're kind of 5 to 50 million. And I have actually heard myself say the same thing that Shiva said. Our sweet spot, albeit 10 to 30 million, we would, if I could do $15 million deals, I'd do them all day long. That's kind of our key focus. If we can continue to add businesses in that size range to our portfolio, that's a really good size for us. Equicapita as a group of companies, we have about 1,000 employees with the 12 companies across Canada and about $300 million in annual revenue. And we do focus to the extent we can on some type of business owner succession, where we're looking to either take out the existing owner and bring up the second level management into some type of ownership position, or just a full sale succession where we bring in new management to sort of complement the existing management team. So we're open for business, looking to continue to do deals across Canada as well as in Western Canada. Of our 12 companies we own, 9 of them are in Western Canada. We probably will continue to have a bit more of an emphasis on Eastern Canada to balance out our portfolio, but we will still be looking closely at Western Canada as well.
Yeah, and can you just quickly explain supermajority? So what's
anything over 66 and 2/3. So our lowest investment size percentage-wise is 70%. So anything more than 2/3. And the reason for that is we're a cash flow investor. So we stream that cash flow we generate from the businesses we invest in to our investor base. So we want to make sure that we work with the management teams, but also have the ability to stream out that excess cash flow to our investors.
And you guys are structured as an income trust, right?
Yes, correct. A mutual fund trust. So a lot of our investors, early investors, came in the form of registered investment dollars, so RSPs and the like. So we have one element of our structure is a mutual fund trust, so an income trust, and then another part is an LP.
Okay, super interesting. Thanks, Mike, for joining us.
Yeah.
Terry, could you give us a little bit of context around, ATB, private equity, fairly new, I guess, kind of initiative for ATB. But tell us about, the transaction sizes you work on and what you guys are looking for.
Thanks, John. I appreciate the invitation today. A friend of mine just texted me that I look like the Godfather on this call, so I'm, now I'm a little bit intimidated. But ATB Private Equity was founded about 5 years ago, funded entirely by ATB Financial. So they're our only GP. We don't go out and raise funds from others. In that time period, we've done 14 investments, combined 2, sold 2. So we have 11 active investees at the moment. Our deal size is between $500,000 and $5 million, and we must be a minority shareholder. So we could take the other third that Michael doesn't want and be a partner in that kind of situation. We were founded on the thesis that we have an aging group of entrepreneurs in Alberta that often don't have a second tier group of successors that have a balance sheet personally to be able to affect a buyout. So we're there to bridge that capital and also to provide growth capital for businesses that are ramping up quickly. So we are sector agnostic, but we do have some prohibitions. First of all, the business must be headquartered in Alberta. And then there's 4 things we can't do. We're not allowed to do real estate, energy production. We can do services, but not production, startups, and fintech that competes with ATB. So we don't have a deal size limit. Quite often we will lead capital structures where, given that we have to be a minority, we can bring others into the investment and still take out a majority if required. But we will always be less than 10% of the commons and less than 50% of the overall equity.
Oh, that's great. Thank you. And we talked about this before, Terry, but minority equity investing is something that's fairly new, a new trend in private equity. And you know, we've chatted about how, you know, it's such a great fit for a lot of entrepreneurs that want to continue to grow their business, but don't want to give up control. So, you know, maybe quickly, can you just let us know why you went that way, why you went as kind of that minority investment versus kind of the majority that is more typical in the private equity world?
Well, firstly, the ATB Act says we have to. And, you know, if we own more than 50%, our investees would be crown corporations. So
Yeah.
that'd be a fairly negative. But you're right, it also has a lot of appeal to entrepreneurs who don't like the feel of giving up legal control. The previous fund I was part of, Northern Plains Capital, also did only minority investments. So you have to present a value proposition to the company and management that says, you know, this is the one board member I want to phone at midnight when I have a problem. You know, the ATB connection means something and is useful to the business. And we can bring more than just a wallet. So board members that are useful to the business, either with customer connections or governance or strategy, and, you know, create that overall perspective that allows us to prosper as a minority, still impact the business in a positive fashion, but not have legal control. So it's an interesting dynamic. It doesn't always work, but you know, it's something that appeals to Alberta investors.
Mm-hmm. And are you mandated just to do investment in Alberta, or can you go outside of Alberta?
It has to be headquartered in Alberta. We would encourage our investees to have sales and operations outside of Alberta, but it has to be centered here.
Okay, great. Thanks for that overview. So just moving on, Mike, over to you. Let's talk about the challenges of closing a deal in this environment. We're probably, you know, like coming on 11 months into this pandemic. How are you overcoming some of the obstacles around, you know, doing things remotely, not being able to go on site, virtual due diligence? How are you overcoming those obstacles?
Well, it's a good question. I'm not sure I can actually tell you yet how we are overcoming it, given that we haven't successfully completed a deal since December 31st, 2019. So we're went through all of 2020 without completing a deal. We're currently working on one that has had to deal with some of the challenges you've mentioned, including, as we had discussed as a panel before, you know, how to deal with, you know, the changing income stream, and you know what impact does the government mandated shutdowns have on the business? How do you incorporate the Qs or CUs or however it's pronounced into the earnings stream? And then also, which is often the case, but I think it's exacerbated in the current environment, and that is valuation expectations. We have dealt in a few different circumstances with great businesses where their earnings have become impaired versus historical normalized earnings in the current environment, and the business owners sort of have a leaning towards sort of the previous cycle valuation metrics, which are harder to incorporate when we're looking sort of go forward what the earnings will look like. So we're trying to figure out, you know, how to assess the stability and resiliency of the earnings stream and manage that with the expectations of the business owners on their valuation expectations. And we have to introduce things that we haven't done a lot of in the past, but things like earnouts and bridging mechanisms on valuations. So we're, as I said, we haven't yet closed any. We're working on as we speak, but it is challenging. And I think the reason it's challenging for both sides is that there is uncertainty as to what the coming months and years will look like with respect to the business cycle, the economy, and everything. So lots of challenges. I certainly don't have the answers. I'm trying to go into these deals with an open mind and try and come to agreements that are fair to both sides.
So are you seeing deal flow? Has a lot crossed your desk and it's just, you know, these obstacles that you can't overcome? Or is it the fact that a lot of people are holding off on, you know, maybe marketing their transaction, marketing their deal right now?
Well, we're actually still seeing a fair bit of deal flow. What we haven't done as much of that we have done in the past is as much outreach directly for proprietary style deals. So we've been contacted by advisors on marketed deals. There doesn't seem to be as much of an urgency to transact. It's more, let's put this out there, see what type of interest we get. We've been surprised that some of the deals that we thought we would have a good shot at still went for a very high multiple that we missed out on. So there's still activity for the right businesses, the right opportunities that are showing stability and resiliency. I think those businesses will always be in high demand, and particularly now. So there's lots of deal flow. There's probably never a perfect time in this current environment to go to market, but if you have a stable business, it will be sought after.
Awesome, thanks. Terry, what are you seeing in the marketplace with regards to, just the deal environment and the challenges that, maybe you specifically have seen in closing transactions?
I think in the early part of the pandemic, there was quite a big challenge around getting debt providers to participate in capital structures because the level of uncertainty was just so overwhelming. So I think some of that has calmed down. Somebody's having trouble hearing me, so I'll just make my microphone a little bit closer. We've actually managed to close 3 deals during the pandemic. I would say we had windows where we could actually do face-to-face due diligence during that time period. So you always want to look somebody in the eye before you write them a check, I think. So that has slowed down a lot of transactions in sectors where you can get people together. The 3 that we did were all technology enabled businesses. So we were able to do a lot of due diligence online, do customer references and things like that. In an environment where you don't have to tour a job site or kick tires on hard assets and things like that. So those kind of deals are somewhat easier to do. We certainly have no shortage of deal flow. I heard from 3 different funds that we've never transacted with this week looking for our participation in things. So I think the fact that we have been active and that there's a certain element that thinks Alberta is cheap right now before a recovery. So there's lots of action around companies. Whether it's a good time, if you're a seller, is it a good time to exit? To Michael's point, if you have a stable business, it's going to be highly sought after. I was involved with one earlier in the year that it didn't close, that it had a lot of interest, mostly from larger PEs that went away because they had to address their own portfolio issues in light of the pandemic. But the business was really stable through the course of the year, and probably a likely candidate to go out again early in 2021.
As Michael mentioned, are you seeing mechanisms and deal structures to kind of bridge the gap between valuation expectations?
There are, and I think that it comes down to, do you believe anything about 2020 and a one-line COVID normalization in calculating EBITDA?
Yeah.
And how far back do you have to go to have a gauge on what the business is going to do going forward? Because all that history is just an indication of what's going to happen in the future. So how do you really assess future activity, revenue, cash flow, and so on, as well as CapEx? Like, nobody's spent a dime in the last 18 months really on assets. How much refurbishment is going to be required to make the business productive again? So yeah, there quite often there is a bridging mechanism. In addition to earnouts and things like that, we've seen a lot of convertible notes where you're effectively putting in a debt instrument so that you have some form of return in the midterm, whether it's a PIK interest or a cash interest piece, and then that's converted at an agreed upon ratio based on agreed upon results. And then the other structure we've used quite effectively is a warrant structure, where if things don't unfold the way that management is presented, we have the opportunity to earn a substantially higher piece of the business for a relatively nominal cost. A lot of people don't like that structure because it feels like a bet against management, but it's also effective.
That is interesting. I've never heard of that warrant structure. So that's something that's is definitely innovative. Shiva, I want to get your thoughts, but before I do, I just want to remind our audience, if they have questions, they can enter them into the Q&A panel, and we'll address those towards the end of the discussion here in the last 10 minutes. So Shiva, get your thoughts on just challenges in the current deal environment. Are you seeing deal flow? How are you overcoming, just the, physical restrictions on meeting potential partners and potential opportunities?
Yeah, thanks, John. I'm going to say the word that nobody else is saying, which is COVID, right? COVID. And for us as a family office, it's hard to get to know people and build rapport in the current environment, which is maybe a slightly different take on things. We need to nail the cultural fit that we have with our partners, and that's really difficult to do over Zoom. So the impact for us really comes down to time and having some people who are willing to spend the time with us to explain what they're doing and to make sure that we have the cultural fit and the cultural alignment, which is really critical from how we invest. I would say that existing networks really matter in this particular time. So as a business owner, some people keep their heads down in their businesses and they don't kind of poke their heads up. I would say to those folks, might be a good time to kind of get out there and reach out and start pushing into your networks, because things they'll just take a little bit longer to get done. And it's exceptionally hard to build new networks right now, right? So you're really leveraging on some of the stuff that you've had in the past, right?
Do you find the opportunities that you're in, are they more proprietary in nature, where you built a relationship and there's just kind of the chemistry is there, or are you actually involved in kind of competitive auction processes?
So we're involved in both. And I would say it's probably about a 50-50 split. We haven't, again, I don't have a long track record history here, right? So but we're not seeing, we're seeing decent deal flow is what I would say, right? So there's a number of deals coming in, and at any given point in time, we've got a number of them on the deck. So it's not, hasn't impacted us that way. The type of businesses that we tend to invest in, when I mentioned earlier about enduring profiles and kind of long run type businesses, a little less impacted by some of the COVID impacts that you've had in some of the retail sectors.
Awesome. Terry, let's talk about the changing landscape of investment in kind of the more traditional Western Canadian industries, oil and gas services, agriculture, forestry, manufacturing, construction, to some of these kind of newer emerging industries such as cannabis, technology, AI. I know you're on the board of Alta ML with, my partner in Divestopedia, Corey. So I'm sure you get a lot of exposure to these newer kind of industries that are emerging in the Western Canadian economy. Can you just talk about that? Is there still appetite for the traditional industries versus these new emerging industries?
I'd say there's appetite, but the buyers are all on a diet, and that means that their valuations are a little bit lighter than they would have been historically. So, I've seen several OFS deals in the last month or so that are priced sub 3 times EBITDA. And, it's kind of hard to figure out what is TTM EBITDA with SUS and this and that and the other thing. And that's kind of my reference to the CapEx profile as well. What really needs to get spent to ensure that that business can operate. We've really had to get our heads around this new technology component and, how businesses impacted by the pandemic have either prospered or pivoted or sought new markets. So a good example would be our last investment is an Edmonton-based company called Shobi, which makes educational software. And only 5% of its client base is in Canada. So it's really an interesting business. It would compete effectively against Google Classrooms and others. And it's a sector that all of a sudden has become extremely hot. Like I saw 3 different educational software deals in the US this week. So there's companies that are consolidating that kind of enterprise and building it up into a real industry. And I think I said at the start, we don't do startups. Shobi's not a startup. It's been around for 7 or 8 years, cash flow positive. So it's a sweet spot that's interesting to find those tech companies that actually have become profitable, aren't burning cash on writing code and doing sales. And there really is a market here in Alberta. Like if you look at the Alta MLs and the Benevides and some of these enterprises that have really scaled, that's a wave we want to be part of, but not at the risk of spray and pray, as Shiva said earlier. The other sector that you mentioned is agriculture. Agriculture is actually really hot. So, I think Bill Gates is the largest landowner in the United States of farmland. So people are applying all manner of interesting technologies to crop science, food security, and other things. And yeah, nobody will like this statement, but we actually are going to benefit from global warming here in Alberta and northern climates, and we're going to have bigger or more crop turns and other things, and people are trying to assess how to play that productivity improvement. So lots of interesting things in ag. So it's borderline technology, not buying implement dealers like we used to.
Yeah, and there's a lot of gray between VC and the private equity world, right? And there's been a lot of successful IT and technology businesses. Jobber raising $6 million here in the last couple of weeks has been pretty amazing. So, Shiva, maybe want to get your take on just kind of investment in these more non-traditional type of industries. What is your guys' appetite in those spaces?
We don't invest in cannabis or casinos at all. That's kind of a part of our values, right? So a little bit different from maybe some other folks out there. We can be counter-cyclical because we take a much longer horizon. So we don't tend to follow the herd in general in any way. And I'll give you an example. The genesis of a lot of the wealth that the families accumulated really came from when John Hokinson decided to consolidate the camps and catering business in the 80s in Alberta. And people who were in the oil business in the 80s would tell you it might not have been the best time all around, right? But what it took was somebody with a vision and a plan. And so for us, it's not about sexy technology. We're looking for good businesses with strong management, with a good management team. And technology for the sake of technology is not really going to resonate as well with us as it might with others. We're looking for people who have businesses that are bringing technology in and then potentially seeing kind of a step change or a step improvement. And, traditional businesses are kind of getting beaten up right now. But, Western Canadian businesses that have a scalable platform that can pursue geographic expansion is absolutely huge, right? There are wonderful opportunities there. I think Terry might have these figures closer at his fingertips, but I was a global guy for a long time, and the vast majority of Alberta's exports, I believe it's about 90%, Terry, they go to the US.
That's right.
Which means there is an entire world out there, and we have some brilliant entrepreneurs here in Alberta who have probably focused on Alberta and focused on the US market because that's where the sweet spot was at the time. But there's tremendous opportunities overseas. And, if we can find the right group of management, the right group of people that maybe want to take products and services overseas, that's something that we would absolutely look at as well.
Yeah, and we're not thinking of our investments in technology as technology necessarily, but technology enabled. So, a good example would be PureWeb, which has a product called ResMD that allows you to do MRIs and X-rays and stuff online. And their real skill set is moving vast amounts of visual data around the internet on virtual servers quickly and efficiently. So now their next product line is virtual conferences. They've done car shows in Vienna for Volkswagen. They've done British Telecom conferences. So it's really kind of a unique play on enabling online entertainment and meetings off of their core competencies. So I call that technology enabled, not just a pure tech. I got a bunch of propeller heads writing Python in the back room.
Yeah, I mean, with technology, it's hard to put border around a lot of the technologies. I mean, so in a lot of cases, like you said, sales, cross borders may be easier in those types of businesses. Mike, you have a pretty diversified portfolio of companies. Maybe talk about your interest in some of these other less traditional Western Canadian type of industries.
Yeah, I mean, I might be a bit of an outlier here. As I mentioned, we kind of have our 5 key silos that we're focusing on. And again, I'll repeat them. It's industrial, royalty, franchise, distribution, healthcare, and then environmental and regulatory. So what we do, not too dissimilar from what Shiva and Terry have mentioned, is we're looking for businesses that fall within those silos that actually utilize technology to make their businesses stronger over the long term. But we, to the extent it was cannabis, if it was something related to some type of distribution of a support industry to the cannabis sector, we'd look at it. We wouldn't, acquire a cannabis grower or anything like that. Not that we could afford it, or anything to that extent. But we're one of our criteria. I mean, we're still looking at the traditional, conventional, strong businesses in Western Canada. One of our key criteria is stability and longevity. We want to acquire businesses that have been around for 40, 50, 60 years, that are such representing, the backbone of the Canadian economy, that they'll still be around for 40 and 50 and 60 years, provided they continue to focus on how can we make our business better, by utilizing technology, looking at continuous improvement and the like. So, we still like those long-standing businesses that are cornerstones of the Canadian economy, and we'll continue to focus on them, as opposed to chasing, the newest, shiniest, most exciting deal on the platform.
Yeah, I mean, you make a great point. Is now a good opportunity to make an investment when everybody is, kind of shying away from, the more traditional construction, oil and gas, manufacturing? Is now maybe a good time to make that investment in some of these businesses?
We think so. For our existing portfolio companies that are more traditional, we think it's a great time to pick up the pieces from, USPE that decided that Canada is no longer the place they want to be, and some larger pubcos that see a division as no longer core. So those things are really good opportunities to be able to plunk into the existing portfolio for us.
Mm-hmm.
Yeah, and we're the same. I mean, to the extent that there's an opportunity for a bit of a smaller deal that fits within our portfolio as a complementary business to one of our other businesses, we'll look at it for sure, to the extent it makes that business or that silo stronger for us and represents a stronger earning stream.
Yeah, same for us as well, right? And in addition to that, I mean, if there's opportunities to take a couple of small businesses and build out a platform that maybe can then go beyond Western Canada, that's also a big interest for us.
Mm-hmm. Shiva, staying with you, what's some advice that you would give to business owners that are seeking, private equity capital, and adding to that, what are some common characteristics that you see of great management teams that you invest with? Like, oftentimes a business owner will come to me and say, I'm looking at exiting my business. I want to find private equity. And I kind of look at them and say, and see that they don't have the characteristics that oftentimes a private equity firm would find attractive. So maybe, again, talk about, some of those characteristics that you see in great management teams.
Yeah, so answering kind of the first part of the question, right? Really critical is alignment of goals and strategy, timing, and how the balance sheet is going to come together. You really have to, and alignment, I can't reinforce that word enough. It's find a group of people that you want to work with, who you are truly disclosed with, have the comfort to be disclosed with, and are really aligned, right? Keep time your friend, because as I mentioned earlier, things are maybe taking a little bit longer, and you may want to talk to a few different people to find that right fit and that right alignment for you. And the alignment on liquidity horizon is also quite critical, right? So make sure that they understand where you're coming from, and you understand where they're coming from, because it just, doing all of this up front just saves a lot of pain at the back end, right? And from our side, I would say that our investments, it's kind of like a marriage for us, right? It requires really good chemistry. You're going to interact with the family. They're going to want to meet you, and it's, they're investing their money. So they're riding with you very much and looking to make sure that the two of you are successful, right? Both us and them. So it's very much like a marriage. Can't reinforce that enough. In terms of the management teams that we would look for, I would say characteristics, humility. We don't want to be managing egos. Integrity, people that we can trust. Open-mindedness would be another one. And then the drive to improve and evolve the business, right? But maybe a little bit different, salt of the earth people, people that we definitely have a sense of trust with, and a culture of putting the business first. One of the great quotes I've heard around here is, if you take care of the business will take care of you. And so if we see those characteristics in those management teams, those are the ones that kind of will resonate with us the strongest.
Mm-hmm. Mike, switching over to you, same question. So what advice would you give to business owners that are seeking private equity capital? And, again, the common or the characteristics that you see, would be in line with the management teams that you invest with? You're just on mute there, Mike.
Yeah, I think that, the most important thing is to, a little bit to echo what Shiva says, is you really have to look for fit. And I think it's important for both sides, for the private equity fund and the business owner management team, to have a fit with each other, whether it's going to work over the long term. And I encourage business owners to really go with their gut. I mean, it's a little bit harder, as my panelists have acknowledged, doing due diligence in this current environment, because all the deals we've done since we launched have been, face-to-face deals with people that we've grown to love over time and have become very close friends. And that's an important element for us. When we started Equicapita, it was, we want to do this because we want to work with people that we can be friendly with, open and honest and challenging, but we want them to be friends. And that's an important element. So fit is crucial. So go with your gut. I encourage anyone who's working with a private equity firm or fund to check that firm's references. Talk to the business owners of the deals that they've already done to get a sense for, is this a firm that, looks good on paper, but do they actually do what they say? Do they follow through on what they're telling you? A lot of groups can tell a great story, but it's important that the story actually plays out in real life. So, that's a big one that I think that is important. As Shiva said, it's a marriage, and in a lot of cases, you don't want it to end in a bitter divorce. So you're better to go in with eyes wide open and make sure that it's going to be a good fit, and don't rush. Like, take your time, and especially if it's a deal where the seller retains a percentage in the business. It's an important transaction. With respect to characteristics of a management team that we look for, actually, it's kind of, I'll look at it the other way. We're looking for people that are really open-minded, looking to improve and grow their businesses. And we are very leery in the setting of a transaction or due diligence if we ever hear the phrase that's the way we've always done it. So we tend to look for folks that are wanting to work with the business that they've had for 30, 40 years, and they're looking for ways to make their business better, to continue to stay a little bit ahead of the competition. So they're looking for opportunities for improvement. So, I mean, that's key for us. And also, we're looking for ways to identify whether that culture is an important part of the business, and whether it's a top-down management by force of personality from the top, or if it's actually a cohesive group that really works well together. That's an important element for us, because we tend to be pretty open with the teams that we work with. So we want to make sure that culture continues.
Yeah, and I'd echo your comment around fit. I mean, the clients that I work with, it's so important that there's chemistry between the partner. This is more than just a financial transaction. It's also a working relationship. So having that that common alignment of goals and just that chemistry is important. So I like that answer.
I've heard it referred to as a bit of a cosmic bond. So you try and form that cosmic bond, and that's that can be magic.
Yeah, and you need to talk to a number of different private equity groups to see which one, just to compare and contrast what the what the chemistry is between any two parties.
Mm-hmm.
Terry, what would be your advice to business owners? I mean, I've known you for probably 15 years, and you've always given me some amazing advice. So maybe you can share your wisdom with the business owners that are on this panel discussion.
Sure. So I would echo all the things that that Shiva and Michael said around fit and culture and that kind of stuff. So just to take it down a little bit different road here, a lot of the deficiencies I see in companies that present to private equity tend to be around fulsome understanding of financials. So lots of them are good P&L managers, but they don't understand their balance sheet and their cash flow. If you really want to impress a private equity sponsor, you need to understand how all of that fits together and what happens with a different CapEx program versus, how much debt were we accumulating through COVID on these government support programs, really being able to talk crisply to that. And then secondly, total addressable market and how you're actually going to take the capital that's being provided and grow. So if you don't have a real strategy and a real plan around that, then what's the point? If you take the money and it just sits on the balance sheet, or you take the money and it just, kind of gets eaten away over time in operating declines, then it's the wrong kind of business, wrong kind of partner. So really understanding your growth plan, understanding your competition in markets, and the financials, I think, are really important.
Yeah, I mean, those are great specific examples, and I like the one around the growth plan, right? Like, how does the private equity actually get their money back and earn their return? Really explaining that and articulating that to a private equity group is impressive, and I find that business owners don't do that, maybe well enough.
I think they assume that everybody knows what they're talking about because they're so ingrained in it, and sometimes you just have to educate.
Yeah, no, it's that is true. Mike, question here for you around, and I can't remember who touched on it, but just around differentiation. I mean, there's so much capital out there in the private equity world. I think it's estimated $1.5 trillion of private equity kind of dry powder sitting on the sidelines. Like, how does a private equity firm differentiate itself? Maybe expanding on that, what are the advantages of finding a local private equity partner versus finding, a private equity partner from the US?
Good. Those are good questions. I mean, the first part, how we differentiate ourselves is, it's difficult. When we started our fund 8 years ago, it seems like a lifetime ago, but it didn't seem as though the lower middle market, $5 to $25 million market space was as crowded as it is now. It was a little bit easier for us to, go into a process and differentiate ourselves by virtue of the fact that we were focused exclusively on that lower middle market at the time we launched Western Canada, and have since expanded. But I mean, where we sort of have differentiated ourselves is we have ensured that when we communicate to the management teams that we maintain the legacy of the business. And we've found that that's an important element for our business owner partners and sellers we work with. So of the 12 deals that we've currently completed, we've never made a name change. We've always maintained the legacy of the business. We've been careful to preserve and maintain and nurture the culture that is in place. For a lot of business owners, this is like their baby, and we want to make sure they know that we find their baby just as cute as they do, and we want to keep it that way. So that's one thing. We also have a perpetual hold strategy, so we're not looking to buy a business, lay off half the staff, merge with another company, and sell it 2 years later. We want to buy businesses that have been around for a long time, work with the management team, and continue to make it better over the long term. So, I mean, that's kind of, for us, we just do it by trying to form good relationships at the outset and work with people and continue to do what we say we do. And I know that's not unique or shiny or flashy, but it has worked well for us over the last 8 years, just by doing what we say we're going to do and executing on it. And with respect to advantages of finding local private equity, I mean, I suppose it can cut both ways. I mean, we're involved with our businesses. We're very close with the companies we work with. We are engaged with the management teams. We are usually, a quick flight away, or I mean, today it doesn't really matter whether you're far away or not, given the advent of Zoom and Teams and video conferences. But for us, we want to get to know the people we work with, and it's easier to do that when you can, absent the current environment, meet face to face and talk about strategy and insights and perspectives and new growth initiatives. Face to face is often easier, and there's also just an advantage of cultural fit, just by being in sort of the same geographic area. We understand what's going on in the relevant economic space. So I think that's an advantage. But I mean, there's probably advantages with you know, the broader market for specialist firms that may have more expertise in a certain segment that may be a fit for a company as well. So it depends on the situation, I think.
Yeah. Terry, same question to you. Like, you know, how does, you know, ATB private equity differentiate itself? And again, what do you see as the benefits of finding a local partner versus, you know, somebody from out of region?
Well, ATB in particular has a vast network of intelligence for, you know, Alberta in particular, and generally through ATB Capital Markets through Canada. So we can offer that as an advantage, you know, access to the analysts for the cannabis space, or you know, the guy that covers Boyd Auto Body, you know, that are part of ATB Capital Markets. So there's an advantage there. I'd say the other thing that actually works really well is the fact that we are a lot more patient, I think, than out of market participants who just want to fly here, do a deal, and go home. You know, we'll work on relationships for years until it's the right time for the company and the right time for us to get together. And to Mike's point, you get to know them over time. You earn that level of trust, and it's not all about the transaction. It's about building the relationship and understanding the business more fully. I think as ATB, we also offer value to those out of market funds that are looking to invest here. You know, we can be their boots on the ground. We'll have risk capital alongside theirs, and we may be a smaller dollar, we can actually disproportionately impact the business in its success by being here for them, attracting talent, and using our Rolodex to build the business. I think there are situations where a specialist firm might be more appropriate. So, I mean, that's what we always sold as Northern Plains, that all we did was energy services and industrials. Thank goodness we don't do that at ATB. But, you know, that was an expertise with connections to Houston and Denver and Aberdeen that made that model unique. So, you know, never be shy about reaching out to what's perceived as the specialist firm that has a track record of taking your type of business to another level. And that may be a step thing. It may be you work with Equicapita or Hokinson or ATB first, and then the next step is engaging that fund that can take you to a different level with more capital and different connections.
Great point. Shiva, you know, same question to you, but maybe give us the focus on like, you know, family office versus a more traditional private equity fund. You know, what's the differentiator there?
Yeah, well, I mean, as I mentioned earlier, cultural fit is really a critical element for us, right? So we want good businesses that want to work with us. That goes back to the concept of a marriage. What I would say is that capital has been overlooking Alberta for a while now, but we, of course, invest here. We have deep roots here. We have a strong reputation and great local and regional networks. And what we find is that people from far-flung places can really be disengaged, and the business often becomes a number. The difference with us is when we commit ourselves, we commit our capital, and we commit the family's money. So we're in it together with you, right? It's very much a marriage. I can't stress that enough. So there's a great symbiotic relationship there. And when we look at, what is the why of being in Hokinson Capital, right? I mean, it's creating that mutual beneficial relationship where we can learn, grow, develop, and profit together. And we really believe in that, and we live that, is what I would say. The other part that might be a little bit different is that the traditional private equity has sort of an institutional network, which we also have and can tap into. We also have access as a family office through a family network, which is a little bit different and not necessarily something that I'd really seen before this, right? So there's a whole other avenue there that can bring resources and assistance to entrepreneurs. It's just a slightly different network.
So that's partnering with other family offices, or?
Yeah.
Okay, internationally or across Western Canada or across Canada?
Yeah, no, I would say that the network is it spans. So yes, internationally and across the US and Canada.
Okay, interesting. Okay, guys, we have lots of great questions that are coming through. So Terry, I'll start with you on this one. You've already kind of touched on it, but what kind of transaction multiples have you guys been seeing recently? Now versus kind of pre-pandemic levels?
Well, it varies tremendously by sector. I've seen some OFS deals that are contemplated at book value. So in one case, sub 2x TTM EBITDA, just because it's, participants that want out of this market. We did one earlier this year that was a spin out from a pubco at 2 times. So that's a pretty daunting sector to participate in right now. And so unless you have a real technology edge to what you're offering, that's can drive productivity and safety to the end customer, it's not that exciting. I've really had to get my head around these technology multiples that are based on multiples of revenue as opposed to multiples of cash flow or EBITDA. So, there's a whole universe of how to value MRR and ARR and all these other stats that you develop in SaaS type businesses that will gain you somewhere at a scaled business, probably between 5 and 8 times revenue, annual recurring revenue.
Mm-hmm.
And the index for pubcos for software businesses right now is over 16. So there's still lots of movement there if you were eventually going to exit to a pubco to be accretive to the pubco and very profitable to you. Not unlike buying a bunch of smaller businesses in OFS and assembling them into a bigger entity, you can buy smaller SaaS businesses at lower multiples and get the arbitrage as you build it into a more meaningful entity. So it's really about just making the math work. The kind of businesses that we all would love, resilient, consistent cash flow, at a sub $10 million level are probably in Western Canada between 4 and 6. Once you get above 10 million, there, as to your point earlier, John, there's so much capital looking at that kind of business. You can probably get, an 8 to 10 times multiple on something that's consistent, never qualified for SUS because the business didn't go down. And there's lots of private equity money that can leverage up and still drive a return at that kind of valuation.
Yeah, and those valuations are, I think driving the return from those valuations is really the private equity has a playbook on how to accelerate growth, there's just so many synergies around it. Is that how you see those valuations getting to that level where a private equity firm can generate the return that they need?
No, I think they're nuts to pay that much.
Okay, I think so too. I just didn't want to say it, but
I think so too.
That's my ambition, though, is to find somebody that wants to pay that for one of our investees.
Yeah,
It won't be Equicapita, Terry.
Darn it.
Yeah. So Mike, switching to you, same question. What private equity or the multiples that we're seeing in the market right now, pre-pandemic versus what's happening right now, and understand that different multiples for different industries?
I think I'm singing off the same song sheet as Terry. Like, it's hard to generalize, across the whole, scope of companies and industries and business models, et cetera. With, when we're looking at deals, we're doing a full scale valuation to determine what we feel the right earnings multiple is that would support the valuation that we can generate the right return for. So, and of course, we're not always successful in the offers that we're putting in, but it could be anywhere from, we're not really active in oil field service, so I don't even want to say it goes as low as Terry had mentioned in the space, but probably anywhere from 4 to 8 times is kind of the market that we're playing in, that we're trying to put in offers in that range. I would say we're kind of getting a little bit toppy if we get over that 6. Depending on the nature of the business. And we tend to have higher multiples for businesses that represent that recurring revenue stream, as Terry had indicated, though for us, that is more on the royalty and franchise business model and the distribution type businesses where you have diversification both on the customer side and on the supplier side. So those resiliency and cash flow and efficiency of capital is important for us in our businesses and necessitate a higher multiple that we're willing to pay. But it is so hard to generalize, I would say.
Yeah. And that rate of return that your firm is looking for, is that still kind of that 25% plus? Because I know a lot of private equity, especially in the US, have really brought down their return expectations to kind of the mid-teens. What specifically for your firm, what rate of return are you looking for on your investment?
Well, we're kind of blended across our portfolio, and again, it really depends on the type of business we're looking at and how it fits achieving our goals of supporting the cash flow to our investors. So I mean, it differs, and whether it's a levered return or an unlevered return, it's I mean, if we can get a 25% straight line return, that's terrific. But sometimes you got to build into that.
Yeah. Shiva, what are you seeing in multiples? I know you're early in the days at Hope and Snow, but
so no, I would echo a lot of what Terry said. So sort of 3 to 6 is kind of what we're seeing across kind of a broad range of industries. And to Terry's point, the 10 million EBITDA is just is a bizarre step that immediately you jump into an 8 to 10. But if you're in healthcare, 14, 12 to 14, and maybe even a little bit higher than that in certain healthcare sectors, right, where they've got that kind of a good sectoral tailwind. So there's a really, really wide variance between different business sectors. And as I said, we don't invest in kind of the kind of pure play technology, which is kind of its own piece altogether, right? But in that traditional business sense, for kind of this mid-market, I would say 3 to 6, and then depending on the sector, it'll kind of adjust within that range.
Yeah, I mean, even you made a good point there that there's that step level valuation increase on a 10 million plus EBITDA business. I've seen kind of lower to mid teens and kind of consumer goods as well. Like it's just I can't wrap my head around some of these valuations sometimes, but
so we stay away.
To be in the pet food business, that's got fantastic multiples.
Yeah, for sure. Yeah. So last question here before we wrap it up. Let's just talk about kind of investment coming in from kind of out of country, from the US into Canada. It seems like it's really dried up here, in the last kind of year. Mike, maybe talk about, your experience with investment coming into Canada and just the interest in Alberta and BC and Saskatchewan in particular. What is the level of interest for kind of foreign investment?
I'm not sure. I'm not sure I can speak to that, John. Like when we're in a process and we're trying to make an offer on a company, we don't really know who the other bidders are. We're not, we usually don't have the insight. And because we're also not really selling any of the companies within our portfolio, I'm not sure I can even give any insight into that. Though in speaking anecdotally to some of the advisors, I think, BC-based businesses, they're still getting a good level of interest from US private equity firms. Alberta, I think if it's still the right type of business that Terry's talking about, that have the recurring revenue of a SaaS model, I'm sure they're getting interest. But yeah, I don't think I'm the guy to answer that question, John. I just don't know.
That's fair. I appreciate that. Terry, maybe get your thoughts on that.
Sure. We have some perspective on it. We actually discussed it at our investment committee this morning. I think the problem with US-based PE money in the last 18 months is they've all come here on the basis of a distressed fund or special situation or vulture. And, nobody wants that money, because they're just going to squeeze you to death. And it's impossible for existing management or shareholders to prosper out of that situation. I think as we get into the back half of this year and I hate to use the term super cycle, but I think there'll be a great improvement in energy metrics and earnings. I think we're going to see a tremendous flood of US money. I think a lot of it's just sitting there waiting, trying to find a home. It's so competitive to do a deal in the US that I think even, coming here and paying in smaller dollars at smaller multiples is how they're going to make an arbitrage in putting a bigger platform together. So I think we're going to see a pretty robust deal environment in the back half of 2021.
Yeah, I mean, that's a great note on which we end this discussion. We're up on time here. Guys, I really want to thank you for taking the time to, speak to me and our audience on this topic. We are going to be sending out contact information for all of the panelists, for anybody that wants to reach out to them. Again, guys, thank you very much. I had a lot of fun doing this. And I hope that our audience found it valuable. I know I did.
Good
Thanks,
luck,
John.
everybody.
Thanks, Shiva, Terry.
Thanks, Mike. Thanks, Terry.
See you guys.
See ya.